So let's jump straight onto this one, and I'm starting with rent to rent, particularly rent to SA. Obviously you get rent to HMOs, rent to single lets, and for those that don't know what rent to rent is, or R2R, is you're essentially signing a lease with a landlord, and you're then above board subleasing that property, but typically changing, either improving the building or changing how that building is operating to create an uplift in the revenue it generates, and then that uplift is what your profits are essentially. So it's important to note on these that I wouldn't actually class this as an investment strategy. I'd argue it's more of a service business, because you're not building an asset portfolio, therefore you're going to struggle to leverage against it, and it's not going to be something that you're going to look to long term. It's solely just a cash flow business. So I'll jump straight into how I've based this on effort, capital required, and experience score. So the effort score I've given for this strategy is a 3, so the maximum. That's because, especially on something like rent to SA, you're going to be hands-on. Well, to start with, most typically to make your profit margin, you're going to be hands-on, moving tenants in. They'll all be short-term lease, so maybe even as short as 1 night, 2 nights, a weekend, a week. I mean, you can get corporate leases that some people take up to like 3 months, which is brilliant. But ultimately, they're going to expect a hotel-style experience, a concierge experience. You're going to be on the end of the phone constantly. You're going to have to do linen changes, and then after every move out, that property needs to look spotless again. The capital required, I've scored it as a 1. Because you're signing essentially a sublease, you'll just need the capital to make whatever improvements you need to that building, if any, but typically that's going to be furnishings and just slight maintenance improvements that might need to be done. The other capital that you'll need is obviously to cover the first few months of rent. This is because you're going to have a period where you'll be paying the landlord their rent, and you'll have a time period to be set up before your revenue starts coming in. So it's going to be a minimal amount, but you can't go into it with absolutely zero cash. You will need some cash reserves. And then the experience required, again, I've scored it as a 1. That's because essentially if you've been in any Airbnb or a hotel, you'll kind of know what these people are expecting. Just a few Google searches, YouTube videos, you'll know what level of standards required, and it's just generally housekeeping for the operational side. You'll want to obviously forecast what your outgoings and income are going to be, and just go from there basically. The positives for rent to rent, and particularly I'm focusing my attention here on renting to SA, but HMO similar, is that you're going to potentially generate a really good cash flow business, and something that you can scale quite quickly. All you'll need to do is essentially find the landlords, sign up the leases, and if your numbers are stacking, you can just keep churning those out. So you could quite quickly replace a full-time job and a full-time income, hopefully. It doesn't require huge cash reserves. You'll need, like I said, you'll need some cash reserve to get these businesses off the ground, up and running, but you won't need massive amounts for deposits and stuff like that. And it's quite a cool strategy that you could then supplement what I'd consider property investing for the long term. Apologies, I've had to change my camera angle because the sun has started to shine in my eyes, and I don't think you'd have actually been able to see me. Also, don't want to burn the forehead. So yeah, as I was saying, the disadvantage to rent to SA or rent to HMO is you're legally bound into a contract. Typically in the negotiation process will be that you're guaranteeing a landlord anywhere between 2 to 5 years of guaranteed rent, typically slightly below the market value, but sometimes at the market value. If for some reason your strategy hasn't gone to plan, or you've got it slightly in the wrong area, or your situation changes, or anything along those lines, you can't afford it, you lose your job, can't afford those first month's rent payment, you're signed into a lease for that period. And it's one of the few strategies as such where I can see you actually being left totally out of pocket if you're not generating a revenue, but you've still got these outgoings. You're going to be worse off than where you started. The other drawback is obviously you don't have the ability to leverage like you do with other investment strategies. as you don't have any equity in any properties. Likewise, that works with you're not going to be able to pay down you're not typically going to be paying down debts or mortgages on any properties. You're not going to be building an asset portfolio for any sorts of pensions.